Hope everybody's having a great day today. I wanted to take some time to shoot a short video. Some of you watch finances, you watch financial news. One of the biggest things that's happened, and it just there's so much going on out there that this happened a few weeks ago. The yield curve, what we called reverted or uninverted. And I'm not going to get into a lot of the details of that because honestly, I've read and I'm still not 100% sure. But it's when it's the relationship between the 10-year Treasury and the 1-year Treasury, and it gets out of whack. What you need to know is that the inversion of it is typically a rare thing. It happens, 15% of the time that we're in an inverted yield curve. But one of the things over the last few decades, a reliable predictor is when the yield curve reverts. It almost with certainty predicts a recession within 12 to 18 months. So what I want to do is talk about that. Not many people are watching that or understand what that means, but along with some other information and data, it's a pretty reliable predictor of a recession. Now, people have been talking about it. I've been talking about something coming for a while. I think it's going to be related to the election. We'll see. But I think some things are being artificially propped up until the election's over. Then we're going to see, we're going to see a recession. We know that's coming. If you look at the past, the stock market and doesn't just perform like a consistent upward hockey stick or anything like that. So we know that's coming. So what can we do to prepare for a recession that's coming? So I've done some research. I just want to share some things with you and talk about, we don't just look at assets to be looking at assets. We're looking at things that are positioned to help us going into a recession. So here we are at the end of 2024. We need to be looking at assets that will position us to, and assets that have performed well in recessions in the past. So that's the part of, if you've been with me for a while, I talk about Smart A. I have Smart A investors. If you don't know what we are, I run a small boutique fund where I bring investments, pre-vetted alternative investments to my investors. I invest alongside them. I also invest with a group of fund managers. We vet deals together, and we only bring our investors the best deals from the best sponsors that have the best timing. So part of the SMART process, the T stands for timing. It can stand for taxes at times too, but timing. And this yield curve reverting is something that we have to pay attention to with timing, okay? Because some assets, it may not be their time during a recession. So what do we do? What assets should we be looking at when a recession hits? And you know what? I asked ChatGPT. For those of you that aren't looking at chat or using chat, it's a great tool. It's almost like having a partner. I love talking to chat, asking it questions about what it thinks. So today I asked chat, I said, during a recession, certain alternate, well, that's not the question. I asked it what asset classes, just coming across as total with no presupposed things, what asset classes across alternatives do well during a recession? So the first thing it spit out was private credit. Now, we've been looking for the right private credit deal for a while, and I think we will have one soon. We've been vetting different operators, and who private credit is loans. It's hard money loans, private loans, and those tend to do well in a recession. Private credit or direct lending can offer stable income streams. So sometimes we can see prefs income, 8, 10, even 12% prefs, depending on the asset class. And if you get into a little bit riskier private credit, it can even be higher than that. So there's always opportunities in a recession because traditional banks tighten up. Now, the weird thing is banks have been tightened up for a while now. If you've tried to go get a loan at your local bank, a lot of them are sitting on their hands. So that's one of the things that's been weird about this. Another thing that performs well, that chat says performs well, is real estate, but it also says certain sectors. So it's interesting because the number one real estate asset is multifamily and affordable housing. So they tend to perform relatively well as housing demand remains consistent even during economic downturns. So that's why people have loved multifamily. over the years. It's a great asset, performs well, but the competition got so great in some of these multifamily markets that people started overpaying for it. And when you overpay for an asset and you don't buy right from the beginning, you're setting yourself up for failure. They also took unnecessary risks with floating interest rates, and they got caught. So multifamily will be coming, and I probably will be bringing a multifamily deal. I've passed on a lot of multifamily deals over the last year because I didn't think the timing was quite right, but it's getting there. Self-storage, we just, that reminds me, I need to wire today. We need to wire a Momentum self-storage deal. We just closed that out. That was not just, it came to us fast, and yes, we jumped on it real quickly, but that wasn't just a blind investment. We did that for a reason. Another one that caught my attention, medical office buildings. Healthcare needs are relatively inelastic, so medical office buildings do well. Not, I'm not saying regular office buildings. You probably, if you live near a city where they're building dentist offices everywhere. So these medical offices are still performing very, very well. Guess what number 3 is? Infrastructure. Infrastructure. Why it performs well? Utilities, renewable energy products, transportation, roads, communication towers. Where our eyes are open for any kind of infrastructure plays. And that's why right now we're looking at the PAVE. If you don't know what the PAVE is, the PAVE is a private equity deal where the sponsors of the PAVE have decided they want to go out and find 6 or 8 mom and pop paving companies. And you'd be shocked when you see how much mom and pop are making owning a paving company. Now, we're talking about paving companies that do things like pave an apartment complex parking lot, or they pave the mall. They pave some of these big pavers. Of course, we have paving on interstates and roads, and there is a lot of money flowing into infrastructure, but these mom and pops don't typically do those big ones. And there's a lot of strings tied to those government contracts. We're looking at this little niche in paving that, you'd be surprised if you saw the numbers on these paving companies. The PAVE has already found its first investment and has bought it, and they have the second one under contract. And they've hired their CEO that's going to run these companies. All these companies are in an area in and around Phoenix, Arizona, or the Southwest. So that's interesting. So, these infrastructure assets have this demand stability built in. And so the companies can grow even during a recession. So infrastructure, I just wanted to key in on that. We didn't just look at the PAVE just because it's a nice private equity play. There's a lot there. There's a lot going on. Number 4 is farmland and agriculture. I still like land investing, and we'll revisit that probably in 2025. Commodities, specifically gold. You'll see a lot more gold commercial people parking money. Gold and silver spot prices are up right now. They've been kind of steady for years. Distressed assets. You're always looking for distressed assets because you can buy them right as long as you can handle fixing the distress. We've also got venture capital. We did some early mid-stage venture capital a few months ago. Some of you were involved in that. Really excited about that. So I just wanted to talk about this because we don't just haphazardly look at assets. And when I talk to new investors or investors who've been around a while, they can kind of go with trendy things. And multifamily was a huge trend over the last 10 years. But now is a great time to look at some of these other assets. They are better able to perform during a recession. And you may not agree with me on the yield curve. Hey, comment below if you agree on the yield curve or you've got a different take on that and what that might mean for the economy. But, we have to look at these things. They are predictors, and when they have predicted something in the past with all the other information, we look at that together and make a decision. One thing I want to say is I truly think the S&P 500 has been propped up. I know it's being propped up by 7 or 8 big companies, and those companies have benefited from inflation, okay? So just because you can charge 40% more for a product because of inflation doesn't mean there was any real true growth there. So I think it's dangerous right now to be overexposed to the S&P 500 to Wall Street. I think that's a dangerous position. So if you're seeing this and for the first time you're hearing me say that, I I think most people need to be more 50-50 split, or if you're like me, I prefer alternatives because I can control those, I can make decisions, and I can go with asset operators who are aligned with me. If I invest with a self-storage facility operator, he wants that facility to perform well too. So as long as you're looking at good operators, you're following the SMART framework. S is for sponsor, is you're finding good sponsors, good operators who know what they're doing, who have a track record and have done it before. M is for markets. You're looking at the market. Doesn't mean you're always looking for the fastest market out there, because sometimes they are in a place where they're teed up for the biggest downfall. So you're looking for steady markets. You like to see growth, job growth. You like to see population influx. A is the asset itself. If you're buying a piece of real estate, you want to buy something with good bones. You want to know what's wrong with it. You want to know if the deferred maintenance has been done or it's not. And based on the asset's condition, you want to negotiate the price the right way, right? R is for risk and return. You've got to be looking at, there's this false belief that if something throws off a high rate of return, it must be risky. But I'm telling you, you can mitigate risk. We can get 12, 15, even 18% returns mitigating risk and still getting those great returns. And T, what we've been talking about today, T is for timing. It can be for taxes, but today, T is definitely for timing. The yield curve has reverted, and that, more likely than not, is the indicator of a recession in the next 12 to 18 months. So with that in mind, what are you going to do with your investments? What kind of shifts do you need to be looking at making? Hey, if you want to talk about this, I love to talk about this kind of stuff. Comment below, or let's get on a call and figure out how you can diversify into alternatives.